Welcome back. Now, starting next month, banks in Kenya will no longer be allowed to charge borrowers blanket interest rates. The regulator has drawn a charter that will compel banking institutions to come up with a plan of implementation, including the publication of hidden charges on their loans. Now, the charter also compels the banks to commit to increasing lending to small and medium-sized businesses by at least 20% by 2020 from the December 2017 baseline. The regulator also admonishes banks for being reluctant to use credit scoring techniques instead of preferring to put all individual borrowers on the same risk bracket. Well, let's discuss all this further with Kamau Kunyiha. He's the CEO of Credit Info here in Kenya. Welcome to the show, sir.
Thank you.
Now, let's start with your views on this new charter from the CBK. It certainly seems like it's good for the Kenyan customer. But we've seen banks are reluctant to use credit scoring techniques. They have been reluctant to use them before. So what is the case now? And give us a sense of what this means for lenders in Kenya going forward.
Okay, I think just to clarify, I don't think I would say there's been reluctance from the banks to actually using credit scores. I think it's basically been more about what they've been selling, the products that they've been selling. So it's been more based on relationship lending. So they have some relationship with the borrower for some time, either through the employer or the individual has banked with the bank for some time. And the agreements that gives them some sort of comfort. So when it comes to personal loans, a big majority of the personal loans are usually given to, in Kenya, is to employed individuals. And there's a tripartite agreement where the employer remits the loan repayment to the bank. So it's a pretty secure loan that is being given. So is there a need for scoring at that point in time? Not really, because I just need to confirm he's employed, and the employer has confirmed they'll send the money through. So moving forward, the charter is a good thing for the underserved or unbanked who are not employed and have not previously been able to access formal financing. So for them, it is definitely a plus. And ideally, that is where the central bank is trying to get the banks to move into that card of consumers.
First of all, do you think banks are willing to go forward with this charter? Because it does seem like there is some reluctance. Some banks have argued that it's difficult to price an individual. There has been some advancement when it comes to credit profiling techniques. So give us a sense of what the banks feel about this. Are they happy with this new charter? And if they do go forward with it, how will it work?
So I don't know if they're happy, but it's definitely they need to do this to be able to win back the favor of the community.
Right.
So there's been lack of trust or belief that the banks are there for the people based on the way they've been lending before making super abnormal profits. Hence the interest cap, because it was felt that they were being unfair, not looking at the general public. So I think the central bank releasing this is actually trying to get back to the people to say, we're not bad, we're here for you, and we're willing to take the steps to accommodate everyone. So I think it would be to their advantage to actually take it on board to be able to convince the general public that, that they are for them and not against them. Yes.
Now, the CBK does want these banks to implement this new charter by September 1st. That's a deadline. It's fast approaching. How would you advise banks to go about getting ready for that deadline?
Okay, so again, it's the central bank has given them from the 1st of September, 30 days to come up with a plan.
Ah, right, okay.
So it's 30 days from 1st of September. So ideally, what they need to do, when you're looking at risk-based pricing, you're looking at now pricing a loan based on the individual's probability of default. Now, that's how the scoring comes into place. But then you just don't implement scoring. You need to be able to backtest the scores that are available in the market to see what fits your risk profile as a bank, what fits your risk appetite, for you to determine what will be the cutoff. At what point would you say this is a customer that would not be willing to take because it's beyond our risk appetite? So they would have to work with their bureaus to be able to understand what that risk appetite is and where they want to cut off. because then they can then they look at, okay, fine, I have this cutoff from this position moving forward is what I'll accept. This is not what I'll accept, and then the process is, the score is just one of many things. You've got to look at other areas that will advise or inform the level or the amount of interest you charge for that facility. So there's quite a bit of work that they need to do. As bureaus, we would help through some consultancy to understand what those issues are, try and define those cutoff points, try and implement this new processes of managing these loans, because it's going to be very different from what they've been doing. And you can imagine all of a sudden a customer that you never would, you're now denying a customer that you not deny before.
Right. Or
you're taking on a lot more customers that you never had before. So it's a whole cultural change within the banking, the whole banking environment. So they would be need for change in the mind, the thought process of how they manage their loans. So it will be a journey.
Very good. Very quickly, is this good or bad for banks in terms of risk?
It's good. Put it this way, if I am able to spread my risk based on, I've got a pool of people, I can spread my risk in terms of those who are good, retain them as good customers, probably charge them less, but also be able to give those that I would not have given loans before, but charge them a bit more. I believe you'd be able to serve a much bigger client base and have a better, healthier portfolio, as opposed to giving everyone one rate, which may be too high for some, unable to pay back. So you just end up putting someone in a position where it's difficult for the person to pay and not really getting the benefits from it as a bank. So I think when you start looking at risk-based pricing, you start looking at all these other factors, I think they will get a healthier portfolio. They'll be able to get a lot more customers. And after all, they'll finally win the trust of the customers again. I think it's a good thing.
Now, looking at the overall sector, we know the repeal of the 2016 rate cap. It's currently in Parliament. Some people oppose it. What are your views on whether that's going to be passed or not? That's the repeal of that rate cap.
Uchi, that's really difficult. You never know.
Sure.
No one expected it to be signed, but it was. So we just wait and see. But again, I think the key thing is that the banking sector needs to win the trust of the parliamentarians and the people. And once that is there, I don't think anyone has an issue with going back to a free market, allowing them to self-regulate. The question is, I think, with the super abnormal profits, they felt that self-regulation was not really working for the banking sector.
Well, many thanks for joining us in the studio. Thank you very much for your insights.
Thank you very much.
Of course, that's Kamau Kunyiha. He's the CEO of Credit Info Kenya.